All right, let's take a deep dive into a multi-step income statement. So first, I kind of want to take a look at the answers for this problem and kind of take a 30,000-foot view when it comes to multi-step income statements. So when you're doing a multi-step, it's really important, at least at this level, for you to have a good understanding of the different sections and the order that they're usually given, right? So our textbook goes over 6 main sections. The 6th is kind of negligible, but let's go over each of them just so you can kind of have a good idea about what each one is supposed to do. So the first section, and I'm actually going to bring up the first two, is the operating section and the non-operating section. And when we're talking about the differences between operating and non-operating, we are talking about the revenues and expenses that are generated from what we're in business for, and then kind of like side revenues and expenses from just incidentals, things that aren't why we're in business. It's just something that isn't really what we're supposed to be getting our revenues and expenses for. So if we take a look at this statement, from our sales all the way down from our income from operations, that is our operating section. Let's give it a color. Orange. All right, so our operating section. So our sales, our cost of goods sold, our selling and administrative expenses, those are all revenues and expenses that are being generated from whatever this company is in business for. This company is actually pencils, pens, and more. So basically, that's what they get from manufacturing, or in this case, probably manufacturing and selling pens, pencils, and more, right? Now, when we dig into the non-operating section, the non-operating section is this area. I'm going to bring it down to income before income tax right here. Let's make it green. This section here is basically talking about all of the additional revenues and expenses, gains and losses, that are generated from activities that aren't quite our operating intent, right? So in this case, we have dividend revenue. So we have some revenue here from our investments. That doesn't have to do with our pens, pencils, and more. We have rent revenue. So perhaps we have one of my favorite examples is usually when you see a big Walmart building and they own that land in that building. And on the side, you can kind of see just a random store that's just kind of tagged onto the Walmart. They had some extra square footage and they decided to rent it out. Obviously, places like Walmart aren't in the business of renting out units. So in this case, this rent revenue is considered an other revenue. It's non-operating. It's not why we're truly in business. In this case, also, we have interest expense that arises from things like debt, period. That would also be considered a non-operating expense. So those will go in your other sections. Now, when you read through your textbook, pay very close attention to the section that talks about unusual and infrequent expenses and gains and losses and so on and so forth. That's going to be really important because if there's anything that is unusual or infrequent, that is going to go in our quote unquote others section, right? So you want to have a good, strong grasp of unusual and infrequent items. Our next section is our income tax section. This is probably the easiest here. So here's our income tax. I'm going to include income from continuing operations in there as well. Let's make it blue. And literally income tax is just calculating the income tax based on the income before income tax that you have up here. And that'll give you your income from continuing operations, which this should probably clue you in that our next section is going to be discontinued operations. Discontinued operations. Now, our discontinued operations is any gains or losses that occur from the disposal or the old operating gain and loss for the period for the disposed operation of our business, right? So, for example, in this one, we have Green Pen Division. Usually when you're doing a problem, it has to be pretty clear whether or not that specific division should be disposed or not, or sorry, if that specific division is significant or not. So for example, if we have a division of our company that is so insignificant, the amount of revenue that it generates is immaterial to us, it really would not go in the discontinued operations section, right? But now if the operation that we discontinued, if the division is significant, then we will have a special area down here called discontinued operations. And one thing that I'm going to remind you of here is that these are technically net of tax. And I'm even going to add them in here because our textbook is pretty good about doing that too. Net of tax, net of tax. And this is simply because gains and losses aren't reported with taxes already built in. However, we've already calculated the income tax on everything north of that figure. So these gains and losses, we have to take the income tax out. And I'll show you guys how to do that when we go through the full problem. And then our last section is the non-controlling interest section. Yellow's kind of close. I guess we are going to do yellow. I can kind of tell. Let's see, non-controlling interest. Okay, so our non-controlling interest might be a little confusing for some of you. Back in the day, when you were in Financial Accounting 2, Chapter 15, you learned about when a company invests in another company by purchasing their stock, right? And you probably learned some very broad rules. You probably learned that you use the cost method for anything less than 20%. Right? So what that means is we would have used something that's called the cost method if we acquired less than 20% of another company's stock. So for example, let's say that Pencil, Pens, and More acquired 15% of a eraser company. If it's 15%, we use the cost method. It's not really covered here in this one, but yeah, we'll actually go over it probably in theory too. So you'll see that again later. The next one you learned was the equity method. And you learned that the equity method is used when, I hate saying this, when we own 20 to 50% of a company. But really, that was just a rule for lower level. The big thing that your focus is on, significant influence. And the big reason why we say significant influence is because if you own a percentage of the company, that basically says that you have a really good chance of getting a certain type of vote when you are voting as a shareholder. That is considered significant influence. You can really influence the company with your votes. Now, cost method, less than 20%, you don't really have control. So if you have no control, you use the cost method. If you have significant influence, you use the equity method. Now, obviously, if we are using the equity method, let's say we own 30, let's make it even better. Let's say that we own 45%. Yeah, let's say 45%. Let's say that we own 45% of a company, but somebody else, one other shareholder, owns 55%. So we own 45%, someone else owns 55%. In cases like this, we don't have significant influence, right? If it's one other person that we own this with, they control the vote. Whatever they vote, they get. So in cases like these, we would have no control. Someone else owns that vote. We can't really control it, right? But if we have several different companies, so we have one company that owns 5%, one that owns 10%, one that owns, now I have to do math in my head, another 5, what is that, 25, We have someone who owns 10, somebody who owns 15. Was that 10, 20, 30, 45? And let's do another 10. So let's say that we have several different shareholders and they all own smaller percentages. They can't really control the vote. In that case, our 45%, yeah, that's significant. We really do have a good chance that we can make a vote go a certain way unless all of these people kind of come together and vote the same way. But in this case, where it's kind of the other side is really shared by multiple other people, we have significant influence there. We would use the equity method. Back in financial accounting 2, we just gave you a rule. If you own 20 to 50%, use the equity method. And then the last method, which we brought up, but we didn't go over how to do it, and we won't in theory either, is called consolidation. This is when you own more than 50% of a company. And if you own more than 50% of a company, you officially have control, right? Just like we were doing with that earlier example with the equity method, we said that person who owns 55% of the company, that's it. They have control of the vote, right? In that case, we have no control. In this case, if we own more than 50%, we have control. Basically, whatever the vote is, we cast our vote. We're more than 50%, so that's it. Now, consolidation isn't something that you learned in your lower level classes because a consolidation is considered a little bit of a more advanced method. It's challenging. I can tell you back when I was in Theory 3, essentially, we don't have a Theory 3 here, but when I went down to Florida International University, they had a Theory 3. And I would say probably more than half of that class is really digging into understanding consolidation, right? Now, when we're talking about consolidation, essentially what you are doing is you are taking all of those companies that you have invested in where you have more than 50% control of that company. We are calling them a subsidiary. So that's what a subsidiary is. When we own more than 50%, we essentially have control. And we are consolidating all of their results from the period into our sales and revenues and expenses in our income statement and balance sheet for that matter. So we consolidate everything for those companies into our own income statement, right? And the reason why we do this is because we say, well, we own more than 50%. We can control a vote when it comes to dividends. We can control a lot that has to do with that company. But the only issue is if we don't own 100% of that subsidiary, then there is a portion of it that is owned by somebody else. Now, if somebody else owns a portion of that subsidiary, what we have is non-controlling interest, right? So non-controlling interest is the portion of ownership that is owned by somebody that is not us. So let's say that we have a company. We'll do the same thing as before as we were doing for that eraser. In this case, let's say we own 55% of Eraser Company, and we have multiple other people that, if we put it all together, they own the other 45%. This 45% is the non-controlling interest. So when we're consolidating all of the subsidiaries' revenues and expenses, gains and losses with ours for the period, at the end, we will take out any net income for our subsidiaries that are attributable to the non-controlling interest portion, and we deduct that out at the very end, which leaves us with the net income that is attributable to us, which would be the parent company. This is where I hope you have a pretty good understanding of the difference between a parent and a subsidiary, right? And if you don't, please be sure to go ahead and take a little bit of time, try to get a good understanding about what the difference between a parent and a subsidiary is, because it's really going to help you have a better foundation of what this NCI is for our income statements. Okay, now that I spent about 15 minutes going over just what the answers to this is and kind of deconstructing this, I'm going to make a second video where we go over how we actually create this based on this data that was given to us here. Okay, stay tuned for part 2.